welcome to the Deep Dive. Today we're diving into something pretty massive. Our sources are calling it a tectonic shift in global finance.
Yeah, it's definitely not just a few new apps or, minor tweaks.
No, exactly. This feels like a fundamental rewiring. Markets, trust, risk, it's all in flux.
And it's driven by this powerful convergence of three major forces hitting at once.
Right. You've got the maturing of artificial intelligence, AI, then there's sustainable and ethical finance, ESG, really going mainstream.
And the third one, the relentless evolution of digital assets and decentralized finance, DeFi.
It's a lot. A huge amount of complexity for anyone to really track.
It is. And that complexity, that's what seems to be paralyzing authorities worldwide. So our mission here in this deep dive is to try and cut through that for you.
How are we doing that?
By focusing on what our sources see as the core conflict, this global regulatory trilemma.
Okay, the trilemma.
Yeah, every country is basically juggling three competing goals, almost contradictory, really. They want to foster rapid innovation, ensure financial stability, and protect consumers.
Crucial.
And maintain national sovereignty over their own economic systems. You can't easily maximize all three at once.
Makes sense. So we'll look at how we got here, the history, how it impacts you, the individual investor, right now the good and the bad.
Right, the empowerment and the peril.
And then dive into how different countries are trying, or maybe failing, to solve that trilemma.
Exactly. Because these shifts, they're fundamentally changing the whole relationship between financial firms and, well, us, their clients.
Okay, let's rewind a bit, the history. Because, to get why things are so turbulent now, we need to see how these three different paths sort of crashed into each other.
Absolutely. Let's start with AI.
Yeah, AI feels like it just exploded onto the scene, but its roots in finance go way back, right? And they're tied to infrastructure limits.
Decades back. I mean, the initial excitement in the 50s, 60s, it hit a massive wall in the mid-70s.
The first AI winter, they called it.
That's the one. And the sources are clear. The reason progress just stopped was pretty simple. Not enough computing power. And crucially, not enough electronic data to actually train anything complex. It's a key point, really. AI progress is always tied to the hardware and the data infrastructure underneath.
So if they couldn't build machines that learned back then, what was the next step? How did they keep going and build something useful for finance?
Well, they pivoted. In the 80s, they shifted to what they called expert systems. These weren't learning machines. They were designed to mimic human experts. Think of Plan Power, debuted in 1986.
Right, I remember hearing about that era.
Yeah, it gave financial plans, but only by following these really rigid if this then that rules written by humans. It was smart, but brittle.
But it set the stage.
Exactly. It set the stage for the real revolution later, the shift to machine learning, where the machine figures out the rules from the data instead of just being programmed with them. Big difference.
That definitely clarifies the jump to now.
Yeah.
Okay, let's switch gears. ESG. Its journey is just as long. Started way before fancy corporate reports.
That's right. You can trace the idea back to, well, faith-based investing in the 18th century, believe it or not.
Really? Like who?
Groups like the Quakers, they practiced what we'd now call exclusionary screening, basically deciding not to invest in things like slavery or alcohol based on ethics.
And then that ethical idea got political teeth later on in the 80s.
Precisely. The anti-apartheid divestment campaigns were huge. They showed that, hey, investment decisions could actually be used to push for political and social change.
But it wasn't quite mainstream ESG yet. When did that happen?
The big shift, the formalization, came in 2004. There was this UN report called Who Cares Wins.
Okay.
And it did something really clever. It reframed the whole conversation. It wasn't just about ethics anymore. It was about fiduciary duty and financial materiality.
Ah, speaking the language of finance.
Exactly. It argued that ignoring environmental, social, and governance factors was actually irresponsible risk management in the long run. That translation from pure ethics to financial risk, that's what pushed it into the boardroom.
Got it. Okay, third force, DeFi. The idea of decentralized money. That goes back to the cypherpunks in the 80s and 90s.
Yeah, the ideology was there. They wanted anonymous, decentralized systems.
But it needed a spark, right? A crisis.
It absolutely did. And that spark was the 2008 global financial crisis.
Right. The bailouts.
The bailouts just shattered public trust in the big centralized financial players. And Bitcoin's founder, Satoshi Nakamoto, made that connection explicit.
How so?
They embedded a message right in the very first Bitcoin block ever mined, the Genesis block. It referenced a UK newspaper headline about bank bailouts. So its origin story is literally a recorded protest against centralized failure.
Okay, so Bitcoin was stage 1 digital cash. But that alone doesn't make a whole parallel financial system. What came next? What was the key tech?
That had to be Ethereum, launching in 2015. And crucially, the introduction of smart contracts.
Programmable money.
Programmable money, automated agreements, that innovation was the game changer. It let developers build actual decentralized applications, dApps, things like lending platforms, MakerDAO, or exchanges like Uniswap.
So not just currency, but financial services.
Exactly. A whole parallel ecosystem started to emerge, posing a much bigger challenge to regulators than Bitcoin alone ever did. So that brings us pretty much up to date. And for you, the individual, the consumer, the investor, this convergence creates this intense duality.
Duality, how so?
Well, on one hand, you've got unprecedented empowerment. On the other, significant new dangers, new perils.
Okay, let's start with the empowerment side. Our sources talk about things that sound almost sci-fi, like hyper-personalization.
Yeah, think about AI-driven financial planning that adapts on the fly when your life changes, new job, new baby, or insurance that adjusts your premium based on your actual driving in real time.
That feels much more responsive, much more client-focused.
Totally. And it's also about democratization. These sophisticated tools, AI robo-advisors doing complex portfolio management.
Used to be just for the super wealthy.
Exactly. High net worth clients only. Now, they're available to almost anyone, often at very low cost. Plus, you look at DeFi, it holds out this promise of financial inclusion for, the 1.7 billion people globally who are unbanked?
Wow, that many.
Yeah. All they'd potentially need is an internet connection to access basic savings, lending, global services.
Okay, that sounds like amazing progress. But obviously there are risks. That's where the regulatory tension comes in. Where do the dangers start for the average person?
Well, a big one is algorithmic bias. It's a huge concern.
How does that work?
If you train an AI on historical data, say credit scoring data, that data inevitably reflects past societal biases, right?
Discrimination baked in.
Exactly. So the AI can end up perpetuating or even amplifying that bias. It can lead to new forms of discrimination, like digital redlining, where certain groups are unfairly denied credit by an algorithm based on factors they can't even see.
And that connects to the accountability problem, the black box issue.
Precisely. If some advanced AI rejects your loan application or denies your insurance claim, and the system literally cannot explain why it made that specific decision.
How do you fight back? How do you appeal?
You can't, easily. It fundamentally undermines your right to due process, to understand the decisions affecting you.
Agree.
It is. And the fraudsters are getting smarter too. Malicious use of AI deepfakes, voice cloning, it's creating these hyper-realistic scams.
Tailored scams.
Yeah, tailored to target your specific behavioral weaknesses, making financial crime way more personal and way harder to detect.
And then there are the risks specific to DeFi itself.
Oh, absolutely. Beyond the wild volatility we often see, the sources really stress the danger from bugs or vulnerabilities in the smart contracts themselves.
Code is law until it isn't.
Pretty much. And crucially, in most DeFi setups, there's no bank, no intermediary, no central company to appeal to if a platform gets hacked or fails.
Your money's just gone.
Often, yeah. There's practically no established legal path to get it back.
So that's why regulators are finally stepping up. What are they doing?
Well, you see different approaches. In the US, for example, the Consumer Financial Protection Bureau, the CFPB, they're applying existing laws like the Equal Credit Opportunity Act, which bans discrimination.
Okay.
They're applying that to the outcomes of AI systems. So they're not trying to regulate the algorithm itself, but saying, look, if your AI results in discrimination, that's illegal, regardless of the tech.
Policing the results, not the method.
Kind of. And globally, there are serious discussions about new standards. Things like a potential consumer bill of rights for the AI age.
What would that include?
Ideas like guaranteeing clear disclosures about when AI is used, and maybe a right to have a human review significant negative decisions made by an automated system.
Okay, so that brings us right back to that core tension, the global regulatory trilemma.
Yep.
Innovation, stability, sovereignty.
Yep. And how different countries are balancing those three really shows their priorities.
Let's look at some examples. Maybe start with the European Union.
Sure. The EU consistently seems to prioritize stability and fundamental rights.
How does that show up in their AI rules?
Well, look at their AI Act. It's groundbreaking, really. It's this comprehensive risk-based framework.
Risk-based.
Yeah. They classify AI systems by risk level, and those deemed high risk, which includes many financial applications, face really strict requirements. Things like data quality standards, transparency, mandatory human oversight.
Setting a high bar.
A very high bar. It's creating what people call the Brussels effect, basically setting a global standard because companies worldwide want access to the EU market.
And their ESG rules, same vibe, prescriptive.
Definitely. Very prescriptive, very mandatory.
Yeah.
They've rolled out CSRD, the Corporate Sustainability Reporting Directive, and SFDR, the Sustainable Finance Disclosure Regulation.
Sounds like a lot of paperwork.
Yeah.
Top-down accountability.
It is. It requires a lot of administrative effort from companies. But what's interesting is you see nuances even within the EU. Sources point out that Slovakia, for instance, chose to delay implementing CSRD for many of its firms by 2 years.
Why?
To ease the administrative burden. It shows that even in a unified bloc, that Trilemma bites. Prioritizing stability and comprehensive rules can mean slowing things down.
Okay. And on the crypto side, the EU has MiCA.
MiCA, yeah. Markets and crypto assets. It's another global first. A really comprehensive, harmonized framework for licensing and supervising crypto firms.
What's the focus there?
Big focus on consumer protection, and crucially, they're imposing strict reserve and liquidity rules for stablecoins, bringing them firmly inside the regulatory fence.
Okay, so that's the EU. Stability, rights, harmonization. Now let's contrast that with the United States. Very different approach, right? Prioritizing innovation.
Very different. The U.S. approach, generally speaking, prioritizes innovation and lets the market lead more.
So for AI, no big single law like the EU's.
Nope, no single federal AI law. They tend to rely on a technology-neutral stance, meaning they use existing laws and regulation by enforcement. You have agencies like the SEC, the CFTC, the CFPB applying their existing powers to the outcomes of AI.
So wait for something to go wrong, then regulate.
It can feel like that sometimes. It definitely allows for faster innovation, but the downside our sources highlight is significant legal uncertainty for businesses. You often don't know the exact rules until a regulator brings an enforcement case.
Right. And their ESG approach, narrower than the EU too.
Much narrower.
Huh.
The U.S. focus is almost entirely on financial materiality and investor protection.
Meaning, does it affect the bottom line?
Basically, yes. The SEC's proposed rules focus heavily on combating greenwashing, making sure companies are truthful about climate risks if those risks could actually impact investors financially. It's less about mandating specific social goals.
And crypto in the US, still messy.
Still very fragmented, lots of turf wars between agencies. Is this crypto asset a security under the SEC, a commodity under the CFTC, a payment system? That lack of clarity continues.
Okay, so EU and US taking different paths. What about a sovereignty-first approach? China comes to mind.
China is a clear example. Regulation there is absolutely state-led, state-controlled.
How so with AI and crypto?
Well, AI rules explicitly state that the outputs must align with core socialist values, full state control over the narrative, and crypto. They didn't try to regulate it, they just banned mining and trading outright in 2021.
Wow, complete shutdown.
Complete shutdown. Why? To maintain absolute state control over the money system, sovereignty clearly trumped any potential innovation or market stability benefits from crypto. They just eliminated the challenge.
But not everyone takes that hardline approach. What about, say, Brazil?
Brazil's interesting. They seem to be blending sovereignty with integration, trying to become a regulated hub.
How are they doing that?
They passed a Comprehensive Virtual Assets Act back in 2022. It provides legal clarity and brings the crypto industry under the direct supervision of their central bank.
So control through supervision, not banning.
Exactly. And they're also moving forward on AI with a proposed framework that specifically outlines rights for people affected by AI decisions, trying to balance control with clear rules and rights.
Okay, so we've mapped the past and the present conflicts. Let's look ahead. What are the big changes coming down the pike in the next, say, 3 to 5 years? Our sources are really emphasizing the rise of something called agentic AI.
Yeah, this feels like the next big leap. We're moving beyond AI just being a tool that reacts to AI becoming an autonomous system, an agent.
What does that mean in practice?
These are systems potentially capable of reasoning, planning, and acting independently to carry out complex tasks. Think automated trading strategies or continuous compliance monitoring and reporting, all running with minimal direct human oversight.
That sounds powerful, but also raises questions about accountability.
Huge questions. If an autonomous AI agent makes a disastrous trade or mismanages risk, who's legally responsible? The developer, the owner, the AI itself. We don't have clear answers yet.
Okay, agentic AI on the horizon. What about digital assets? Where's that space heading?
The focus seems to be shifting, moving beyond just speculative trading towards the tokenization of real-world assets, RWAs.
Putting things like property on the blockchain.
Exactly. Things like real estate, private equity, art, traditionally illiquid assets. Tokenizing them could make them divisible, easier to trade, potentially unlocking huge amounts of value globally.
And alongside that, stablecoins and CBDCs.
Yeah, the role of stablecoins is likely to expand, probably under stricter regulation like MiCA. And central bank digital currencies, CBDCs, are moving forward in many countries. That whole landscape is maturing.
In ESG, where does that evolve next?
It seems to be moving beyond just disclosure. Mandatory reporting is becoming the baseline, the norm.
So what's next?
The focus is shifting towards measuring and verifying actual real-world impact. Are these ESG initiatives really making a difference?
Proving it, not just saying it.
Exactly. And the fight against greenwashing will likely get tougher, driven by this concept of double materiality.
Double materiality.
Yeah, it basically forces companies to report not just on how sustainability issues affect the company's bottom line, but also on how the company's operations impact society and the environment. A two-way street.
Okay, now here's something that connects back to our history discussion. The dependency on tech infrastructure.
Yeah.
Is that becoming a systemic risk now with AI?
It absolutely is. Remember, we said the first AI winter was partly due to hardware limits.
Right.
Well, now the entire financial sector is becoming critically dependent on just a handful of dominant big tech firms for the advanced AI processing power and the cloud infrastructure it needs.
How concentrated is it?
Our sources point out that one single company makes something like 90% of the advanced AI processors globally right now.
Wow. One company.
Yeah. So think about it. A major failure, a cyber attack, a supply chain disruption, or even just a strategic decision by one or two of these tech giants
Could ripple through the entire financial system.
Precisely. It creates this huge, new, non-traditional source of systemic risk that sits largely outside the usual financial regulatory frameworks.
And speaking of things outside the framework, regulators have mainly gone after centralized crypto exchanges so far. But what about the truly decentralized stuff? DAOs, protocols with no CEO, no headquarters.
That remains a profound challenge. How do you regulate a protocol that's just code run by a distributed pseudonymous network globally? Who do you serve legal papers to?
Right. There's no there.
Exactly. It really pushes the limits of our existing legal systems, which are built around holding identifiable people or companies accountable.
Okay, one last risk factor before we wrap up. The bubble warnings.
Yes, we have to mention that. Major institutions, the IMF, the Bank of England, they're explicitly warning about the potential for a sharp market correction, specifically in the generative AI stock sector.
Because valuations got so high so fast.
Exactly. Immense market cap concentrated in just a few names. If that bubble bursts or even deflates significantly, the fear is it could trigger serious spillover effects into the broader financial system.
So bringing it all together, what's the main takeaway for the financial institutions caught in the middle of all this?
Well, the core message seems to be that just aiming for basic compliance isn't enough anymore. The new imperative is operational and regulatory resilience, meaning they need transparent AI governance principles, really robust data management, and crucially, they need to understand that technology itself is now a core systemic risk factor they have to manage proactively.
So looking way down the road, all this tech convergence, reg tech, sub tech, could we end up with regulation by algorithm, where compliance is just automatically monitored in real time?
It's definitely a direction things could move. Continuous monitoring, automated assessments, maybe even automated enforcement based on data feeds.
Which leads to a final, pretty challenging question for you, our listener, to think about. If compliance and supervision become fully automated, what happens to human judgment? What happens to due process? Where is the appeal when the algorithm says no? Something to ponder.